Welcome to the third quarter 2011 SEM Economic Update. My name is Jeff Hyback. I'm the Senior Portfolio Manager for Strategic Equity Management. For those of you that aren't familiar with our company, we were founded in 1992 and we're based in Tucson, Arizona. We have a focus on active risk management. Today we want to look at what's going on with the economy. Are we heading towards another recession? And what do our proprietary indicators say about that? Before we get started, let's go through a little bit of housekeeping here. First of all, today's presentation is intended for informational purposes only. We should not consider it investment advice. We always encourage you to contact your financial advisor. Although we don't plan on talking about performance today, if we did, all performance numbers that you ever see on strategic equity are net of the maximum investment advisory fee. All investments involve risk, including those managed by Strategic Equity Management. For more information on our company, you can go to our website, www.stratequity.com, and at the bottom of the page there's a disclaimer document, and it's our Form ADV Part 2, which is our registration requirement with the SEC. Now the question of the day, really the question of the last couple months, is which way is the economy heading? And a lot of people probably have already heard the term double dip, and what they're referring to is, are we going to go back into another recession? Now, just out of curiosity, because I thought I've been hearing a lot about this, I did a Google search this morning for double dip recession, and just the news stories posted in the past week was 4,880 returns. And what I found interesting, if you look at the second and third entries there, the forecast double dip recession inevitable. But then right below that, Business Week has a story that says Daily says no expectation of a double dip recession. And then you could see there's also a bunch of articles about Europe and everything that's going on there. So obviously there's a lot of misinformation out there. There's a lot of unknowns out there of whether or not we are going into a double dip. So all we can really do is take a look at our own indicators. And one thing that I found, my background is in fundamental analysis, where I look at the numbers coming out of the economy, and I kind of can use those to make a prediction on which way things are going. And it's of course not always right. It's not always perfect, but it's more a general guide to let us know which way we're going. And for those of you that have been around strategic equity for a while, you'll remember that at the very end of 2006, we first started talking about the prospects of the economy going into a recession. And if you could have seen us, we were jumping up and down literally at times in some of our seminars telling people, look, all the indicators point towards a recession. So what we want to do today is look back at those indicators and say, are we truly heading back into a recession based on the economic data that we've seen thus far? The first thing we look at is probably the most encouraging sign I see out there to say we're not going into a double dip recession is the service sector. Now, as most of you know, the service sector has become about 70% of the U.S. economy, and it's very important as to the direction of the economy as what's going on inside the service sector. And you can see this business activity index shows that we are clearly growing. Any number over 50 shows that the economy is expanding. And as you can see, the last few months, it's not only expanding, but it's doing so at a much higher rate. The next thing that does point towards the likelihood that we're not going into a double dip recession is the weekly hours index. This was just released Friday morning as part of the jobs report. And what you'll see here is that we did see it. The problem I'm seeing with this indicator, though, is unfortunately the pace of growth in the average work week is slowing. Now, it's not quite pointing towards a recession, but it is something that we're going to need to watch over the next few months. The labor market is also improving. This looks at the percentage change versus a year ago, and you could see the very large decline we saw in the employment index. But since that time, it has been rising, and it's increasing at a pace of 1 to 2%. It's not fast, but at least it is improving. And really, we're not going to go into another recession if you see jobs increasing. The times we go into a recession, as you can see, is when the number of jobs really begins to deteriorate, and we're not there yet. The problem is as we all know, especially if you know anybody that's unemployed, is that that trend is taking a very long time to recover all the jobs lost. And it is something that we'll talk about at the end of the presentation today. But again, it's still not pointing towards a recession, it's just pointing towards a very long recovery. Another thing that really surprised me when you look at the numbers is housing is actually improving. It might not feel like it because, when it's been down so long, it feels like it's up, as the old saying goes. But you can see the year-over-year change in housing is definitely rising. And historically, right around the minus 20% mark is when you would have a signal for a recession. And it just didn't happen this time. You could see it was a very good leading indicator before the last recession. You can see the big drop off that began in late 2005. But for now, it is climbing. Unfortunately, just like the employment market, it's fallen so long that the recovery is going to be very slow. This chart actually, if you extend it all the way back to the 1950s, is when they start collecting data on this index. It's the lowest it's ever been. It's kind of chopping around, but at least it's growing. And again, just like employment, as long as you have some improvement, you're not going to see the economy shrink. We'll get to it again later, but the recovery is what we're more concerned about. Another thing that is still pointing towards growth in the economy, although not as strong, is supplier deliveries. What this does is it looks at how quickly suppliers are able to fill their orders. If they're able to fulfill them very quickly, then it's actually a negative sign for the economy. So when this index is above 50, it says that suppliers are having a harder time filling their orders. And what that means is there's so much demand that they're not able to keep up like they used to do. As you can see, it has fallen over the summer, but it is still above 50, which does indicate growth in the economy. The big issue, though, with manufacturers that may show that delivery index may also fall is the new orders index. This one is one of the indicators pointing towards recession, and it is something that we should be aware of. But as you can see, it just barely fell below 50, so it's not a clear-cut recession signal that we should be worried about. One thing we should start paying attention to over the next few months, though, is the order backlog. You can see that number has declined quite a bit, and it's definitely in recession territory, but by itself is not the only indicator we look at. So this one put it in the negative column, but it is something that, as you can see, can turn around and has dipped below 50 before without us going into recession. The bigger issue I see with the economy, and something that's more of a long-term problem, is consumers are losing confidence. This is the consumer sentiment index. And as you can see, I took a 3-month average because this is such a volatile series. And you can see it's almost back to the lows we saw in late 2008 and early 2009. So it's something that we need to be aware of. But one thing I did notice, if anybody saw the retail sales reports out this week, we had bad consumer sentiment in August and September, but the retail sales really weren't that bad. So consumers might feel bad about things and their prospects, but they still are spending money. And so they haven't cut back enough to really cause a recession. But this one does bear watching as we move forward. The problem I've always had with economic analysis is when I went back and did my study of all the leading economic indicators, I found that stocks are the single best predictor of a recession. And that's because everybody in the stock market is trying to assess what the future is going to hold, and then they adjust their buys and their sells accordingly. And this indicator here I've shown before is a 12-month moving average versus the actual price of the S&P 500. And as you can see on the far right side there, we have fallen below that 12-month moving average rather quickly. And that, with just a few false signals, is a pretty good indicator of a recession sometime in the next 12 months. It does bear watching, and of course this becomes a whole chicken and egg thing of, if we go into a recession, are stocks going to fall, or the fact that stocks are falling, are they causing the recession? Because as we know, it's a lot of people's household wealth is still tied up into the stock market. So let's just recap really quickly. Are we headed towards a double dip? The positive signs we're seeing that say no way are we heading towards a double dip include the service business activity index, the hours worked index because it's still growing, job growth, 100,000 jobs in September. It's not a lot, but hey, it's still growth. It's not pointing towards a recession. Building permits, again, it's not a great recovery, but at least it's growing. It's not subtracting from economic growth. And then finally, supplier deliveries are showing that there still is some demand in the manufacturing sector. Signs of a recession, we have the new orders have really slowed in the last few months, and it is now just barely below our recession indicator. Order backlog has plummeted the last 2 or 3 months. Consumer confidence is near the lows of 2008. And then we have stock prices, which, again, chicken or the egg. Are the falling stock prices causing a recession, or are they falling because the stock, because everybody's worried about a recession? One thing, though, that I think will keep us from a double dip is what I call the hidden stimulus. And if you look at this, is the money supply. This is going on behind the scenes. Sometimes it's a little bit more in front of us when you look at the Federal Reserve and their actions, but we're seeing still the money supply is continuing to increase. And so, as you can see, most of the time the recession is preceded by a period of time where money supply had been declining. As you can see, going back to the mid 2000s, the money supply pretty much was trending lower until we hit the recession. And then when they started doing things like quantitative easing and some of the interest rate policies, you saw the money supply skyrocket. That rate of change has since fallen. And then as we got into 2010, remember last summer, it looked like we were going into a double dip. And so since that time, the money supply has continued to increase. So that is a hidden stimulus that could keep us out of a double dip recession. All those people that said it's guaranteed we're going into a double dip recession are really not paying attention to the fact that we have so much money being printed out there. Now, even if we do go into a recession, I don't think it will be that severe. It might be a minor, 0.5%, 1/4% drop in economic activity. And the reason I say that is these two charts here. The top one is basically the amount of cash that U.S. corporations have on their balance sheets. And you could just see the direction of that, $500 billion as of the last quarter on their balance sheet. Businesses have taken advantage of those falling interest rates, and they've refinanced their loans. They've taken advantage of all the cash that's been made available, and they've really shored up their balance sheets. And then we've seen households. This bottom chart there shows the household obligations as a percent of their disposable income. In other words, what percent of their money in the U.S. household on average is going towards paying your bills, your debt? And you could see a real big problem. The reason the recession was so severe was we were approaching 19% of disposable income going towards debt service payments. And now, as you can see, it's all the way back to 1995 levels. And whether it's been because so many people got foreclosed on, or it's the tightening credit we've seen from the banks and the credit card companies, or what I've seen beneath the surface, it's households deciding, you know what, debt got us into this mess. We're going to cut back on our use of debt. Households are in a much better position now to weather a recession. So as the economy slows down, it may not get severe enough to go into a technical recession. And it's something that all those people calling for a double dip really are not paying attention to. But the problem we have is I don't think whether or not we go into a recession is the issue. And the reason I say that might sound kind of funny because the stock market is definitely concerned about whether or not we go into a recession. And the reason they're concerned is they know the data. The data shows that the stock market loses on average 40% just before and during a recession. Now, from the very peak in April to the bottom we saw earlier this week, we saw about a 17% drop. So we almost took care of half of that number already. So the market is spooked about a recession. But we need to take a step back and we need to look at the big picture. So what really is a recession? A recession, by definition, is just a period of economic contraction, and it's sometimes limited in scope or duration. A good example, and the number most people use, is it's 2 quarters in a row where the economy contracted, where it actually went negative, and we saw it fall a little bit. Then we got to look at what a recovery is. A recovery is a restoration or return to any former and better state or condition. So, in other words, recovery means we're back to being better than we were before. And obviously, everybody realizes this recovery has not felt like a recovery. And that's the big issue to me. And it doesn't matter whether it's a double dip recession or not. We got to focus on how do we actually recover where we were at in 2007. One thing I've been saying for quite some time is we are in a depression. And the reason I say that is the definition of depression is a period during which business, employment, and stock market values decline severely, or, as I have underlined there, remain at a very low level of activity. And as you can see, the cartoon there that I found says, I wish it was a double dip recession. And I'm sure a lot of people are thinking that because I don't believe this is the Great Depression. I don't think it'll be that bad probably ever again because we've made so many advances in technology and some of the regulations we've put into place. I just don't see where we're going to have 25% unemployment and double-digit losses in the economy quarter after quarter like we did in the Great Depression. But everybody's afraid to use that word depression. But if you look at that definition, a period during which business, employment, and stock market values remain at a very low level of activity, it's something that we need to start looking at. We probably are in a depression. And just so this isn't something new. July 15th, 2009, I wrote a market update and I declared the recession over using those same indicators we've looked at today. But as you can see, the last part of that article said depression is still a concern. I remain staunch in that position right now. I'm just really concerned that we are in a depression and none of our policy makers really care to address it. None of the Congress people, none of the central bankers, the Treasury Department, nobody really wants to look at how do we really fight a depression. They're using things to fight a recession, and they're worried about a recession when we really need to look at how do we fight a depression. Now, why do I say we're in a depression? It's pretty simple. Because we didn't recover. We have a horrible recovery going on. I pulled out some of my favorite tools that I've found, and they're called expansion charts. And what they do is the red line is the current level of expansion, and it bases it off of the point in time where the recession ended. And in this case, it was July 2009, which is when I called the end of the recession. And it puts bands around it of the highest and lowest on record. And by the way, the records go back to 1947. That's really when we started tracking the economic data. We don't have this type of economic data for the Depression. And then you can see the blue line is the average. That's where we want to be as far as feeling like we're in a recovery. And as you can see, the gross domestic product, which is the best measure of the economy, is definitely tracking well below average, and it's near the bottom as far as economic recoveries go. But the bigger concern is income is not recovering. You can see this is actually tracking below the very lowest recovery as far as personal income goes. So no wonder nobody feels like we're in a recovery. It's because the personal income, Main Street as I call it, is not getting any money. All the money is going to Wall Street, not to Main Street. This protest going on in New York and now kind of spreading around the country called Occupy Wall Street, there's a reason behind it. People do not feel like they're getting a fair deal. They see Wall Street paying record bonuses, and then they look at things like real disposable income and say, look, this is the worst we've had since 1947 in terms of income growth. What's going on here? How can Wall Street pay record bonuses when we have the worst recovery in income growth? Another reason people are complaining is going back to that jobs number. Yes, it's growing, but look how slow it is. The red line there is how it's doing now compared to past recoveries, and you could see we're a few times we were actually below the worst recovery ever, and now here we are 18 months into the recovery, and it is still tracking near the worst recovery on record. A much more scary way to look at it is this chart that they've been posting on calculated risk for the last couple years. And it shows not only the severity of our drop in jobs, it compares it to all the post-World War II recessions. And they line it up at the very end of the job losses. And you could see, we talked about a jobless recovery in 2001, and in fact, George Bush almost didn't get reelected because of it. But you can see even that would be pretty nice to have right now. It took them about 21 months to get back to where they started following that recession. And you can see we're nowhere near getting back to where we were in 2007 when we hit the peak in employment. So that's one reason I feel we're in a depression. People that had jobs in 2007 not only are not getting their jobs back, but the ones who are at a much lower income level. Another thing that is becoming a big problem for our economy is the duration of unemployment. This takes a look at the average weeks unemployed, and you can see we're right back almost to the highs, which is above 40. So the average person that's on unemployment has been unemployed almost a whole year. It's scary. It's something that we need to look at, and we need to address why are we not able to do this. The current policies look at how you fight a recession, which is just a general normal slowdown. They're not looking at a depression, which is really the structural issues that we're seeing. Another thing that I think is being really largely ignored is the real unemployment rate. This takes a look at what they call marginally attached workers plus all the unemployed. And so that's people that have given up looking for work because they couldn't find a job. It's looking at people who are part-time but they really want to work full-time. And then it's, of course, all the other unemployed people. And you can see it's rising again. And that's not good. That is a big reason behind this Occupy Wall Street movement. So it's something that we need to look for. Again, it's not going to cause a recession or a double dip. It's the depression question. How are we going to get out of this depression that we need to be focused on? And finally, you just look at the long-term trend in our economy has been down. I've pointed this out many times, and that dashed blue line is a linear trend of economic growth. Now, the Federal Reserve, the Congressional Budget Office, everybody is expecting 3% growth in the economy, and you can see the trend is 2%. We got above 3% for all of 2 quarters with the unprecedented stimulus we've thrown at the economy. So in 18 months, we've only been able to grow above 3% twice. And so whether or not you have a double dip recession doesn't matter. In the big picture, which if you're a buy and hold stock investor, you're supposed to be looking at the big picture, not the little picture. The big picture is we are in a depression, and our policymakers are not addressing it. And until they address it, you're going to keep seeing these wild swings in the stock market. You're going to see where it looks like, oh my gosh, the market's going to crash. And then all of a sudden, oh my gosh, everything looks great. And it's almost a weekly cycle now. And we haven't even talked about what's going on in Europe. They're a couple years ahead of us as far as their depression goes. And so we know what the end game is. We just have to acknowledge it. And so when you look at this chart, you can see no matter what we've done, our economy is slowing. That's a depression. It's not a recession. I don't care about a double dip. I care about how can we address this. So we've covered a lot of information today in a very short amount of time. I would like to encourage you, if you want to know more, we actually post a daily blog on our website, and it's posted there on the screen at stratequity.com. You could register as a professional or as an individual, and just click the link there. And then once you get registered and confirm your email address, you can look at what we are saying on a daily basis. One thing we are doing, we are active money managers. We are looking at the current trends and we're trying to take advantage of them. We're either looking to manage risk and move towards defense, or if everything looks all clear when we're in a time of economic growth, we want to pour in and put the offense on the field. And it can change daily. We're watching the market every single day. So I hope you enjoyed today's presentation. As always, you can send us some feedback. Go to our website. You can find my email address, or you can just send us under that contact us form and let us know what you think, if you have questions, comments, or whatever. And we're going to try to do this as often as we can. And in the meanwhile, go back to our website and check things out.